Hey guys, Ryan G. Wright with DoHardMoney.com coming to you with a Just Ask Ryan question of the day. And today's question is, do real estate investors have to pay taxes? This is a fantastic question. And if you've got a question like this or anything else you'd like to have me answer, I'll create a video just like this one for one of my Just Ask Ryan questions of the day. I do a video like this every single day where I answer a specific question about real estate finance, personal finance, real estate investing, wholesale, BRRRR, fix and flip, hard money, whatever the case is. And I would be more than happy to answer a question for you as well. So, do real estate investors pay taxes? The short answer is yes. The long answer is there's some ways they use real estate to legally reduce their taxes or defer their tax liability. So let's jump into this. Taxes, how does this work? Typically, and I'm not a CPA, but just to give you an overview, typically if a property is owned or flipped or wholesaled, you're going to be taxed at your ordinary income rate if you have owned that property for less than a year. If you have owned that investment or that property for more than a year, you're going to get into what's called long-term capital gains. That's actually a good thing because long-term capital gains is actually at a more favorable rate. That said, you're typically not going to do very well in any type of investment if you've only owned the property for a year. If you've owned it for a year, your expenses are going to be too much. Your hard money costs are going to be too much. Your holding costs are going to be too much. So most of the time, that's not going to be a good thing for you. So anytime you're dealing with a wholesale, you're typically going to have the property for just a few weeks. If you're dealing with a fix and flip, you're usually going to have the property for no more than 6 months. So anytime you're dealing with something where you're trying to do a quick flip, you're not going to be able to meet that long-term capital gains. That's what you're going to run into because you've got to have that for over a year before you're able to get that long-term capital gains. So how do you deal with this? Well, a lot of people, when they're doing some fix and flips, which is a great way to get going, doing some wholesale deals, doing some fix and flips, then this gets into actually purchasing and owning properties. Because when you own the property, you're able to do deductions. And you're able to look at the property and see a few things. In some cases, you're able to deduct any of your taxes and insurance. You're typically able to deduct any of your interest. Look at this fire truck. I don't even know what it's doing here. That's cool. You're able to deduct your interest, and you're also able to depreciate. What depreciation is each one of the fixtures and things inside the property is going to be on a depreciation. So they're basically going to say, hey, over this period of time, what's going to happen is that your furnace, for example, is going to get worse over time. So what the IRS allows you to do is to actually depreciate that. What that means is you get to write a little bit off each year because you're going to end up having to get a new furnace later. Now there's a thing called accelerated depreciation where you can have someone come in, or in some cases a computer system will do it, where it'll do those calculations and allow you to depreciate things a lot faster. That's really helpful because if you can depreciate $20,000, that's going to help offset some of your income tax expenses. So that's one of the ways that real estate investors help themselves in lowering their tax basis, is the whole concept of owning rental properties, getting the write-offs from that, and doing some of the depreciation. There's also some investments that people will do where they become a limited partnership in a real estate investment simply for the depreciation. So some things, if they're doing accelerated depreciation, you could make an investment of $100,000 and you could have an accelerated depreciation of more than $100,000 in that first year, which can help offset some taxes. The other thing that's very popular for real estate investors is called a 1031 exchange. The idea with this is if you own a property and you sell that property, you can 1031 exchange that property into a new property. Now you've got to exchange your debt and your equity. It's got to be like for like, so it's got to be real estate for real estate. There's a bunch of rules and there's experts around this, and I'm not one of them. I know some of them, but and I've done multiple 1031 exchanges. This can work out really well. Basically, the idea is though, it's not it's delaying taxes, right? It's not, you're gonna end up having to pay the taxes at some point if you end up selling that property. But when you sell the property, your cost basis, your debt, your equity, and your depreciation all roll into this new property, which puts you into a new cost basis. And then if you own that property, when you sell that property, you then need to pay taxes, or you do another 1031 exchange. Usually what happens is, at some point as you're doing that, if you do an exchange and you buy 2 properties instead of 1, or 3 properties, you may have to keep finding properties. And there's some time frame requirements. You've got to find a property within 90 days, that type of stuff. But that's another way that real estate investors are utilizing real estate to help offset some of their taxes, which is a fantastic strategy. It works extremely well. Depending upon where you're at, is going to depend if you need to worry about this. If you haven't even done a deal yet, don't really worry about it. Don't be overly concerned about the taxes. Don't be overly concerned about doing a 1031 exchange. The exchanges work really well when you're trying to get more investment properties long term, like rental properties. So great question about taxes. I hope you have enjoyed it. If you have, please hit the thumbs up button. It is free to do, and it tells YouTube that you like this video and more people should like it. One of the things you may not know is YouTube doesn't show this video to everybody. They show it to a few people, and if those people like it, they show it to a few more, and if those people like it, they show it to a few more. So you can be a big help. I really appreciate that. Couple of things. I have a video before, man, there's like a there's like a whole hole there. I've got a video about the tax benefits for real estate investors. I'll put that on the screen. You're gonna wanna check that out. It goes in deep with a few other tax benefits you're gonna wanna see. I also have a blog to check out. It is flipping houses still profitable? So you're gonna wanna check that out. I'll put both of those in the description so you can click on those and check them out. Also, if you would like to get my book, I have a book that's on Amazon, Barnes & Noble, it sells for like 25 bucks. If you'd like to get a free e-copy, absolutely free, all you gotta do is text your email address to 435-294-0433. Again, 435-294-0433. Text your email address. Once you do that, the computer will send you a copy, an e-copy of that book, How to Get More Money Than You Can Ever Handle, a real estate investor's guide to funding deals. Otherwise, have a fantastic day. If you're not currently a subscriber, please consider that and hit the subscribe button. Otherwise, if you want some help in real estate investing, from software to tools to resources to money, check us out over at DoHardMoney.com. We've got all the resources to help you out. Otherwise, make it a profitable day, and bye for now.